Welcome to this week's African Agri Overview. This week we'll be delving into why soybean prices unexpectedly increased by more than 40% during the last 6 weeks. All in this week's episode, so make sure to stay tuned. Hi, I'm Dr. Johnny van der Merwe and welcome to this episode of the African Agri Overview. Before we dive in, I'd like to encourage you to follow us on YouTube. By doing so, you'll gain access to regular insights into the agricultural markets of Africa. Our goal is to provide you with valuable information that can help navigate the dynamic world of agriculture on the African continent. You can also contact our regular market analyst, Jacques Pinaar, for more detailed reports on the African soft commodity markets. Currently, all traders are weighing demand forecasts, less than expected US inflation data, and lower demand from China's stalling economic recovery, with the latest price reaching $86 per barrel the past week. But with that said, Jacques will now focus on why soybean prices increased the past 2 months. Over to you, Jacques.
Good day and thanks for joining. Since our last Zambia soya complex discussion late June, not much has changed in our S&D forecast. However, soybean and soymeal prices unexpectedly increased by 40 to 45% during the last 6 weeks. Let's analyze this price move and see if we can find answers. Not much changed in our soybean balance sheet for the current season. We still believe carrying stocks was around 120,000 tons. We expect a record production of 600,000 tons, local crush of 520,000 tons, exports of 120,000 tons, and ending stocks of around 80,000 tons. A relatively healthy balance sheet. As indicated previously, during 2022-23, the government bought 100,000 tons of soybeans for strategic reserves through the FRA. Due to the unrealistically high selling price for the stock, it remains unsold. It is uncertain when the FRA will offload this position. We understand there is pressure from the IMF not to sell the beans below the purchase price, which was 11,000 kwacha per ton or $585 per ton, well above the current market price. This could force the FRA to sit on their position for longer than planned. The market guessed traders, speculators and farmers could be sitting on 150,000 tons. This is a significant position, not tradable at this point, but likely to feed into the market before the next harvest commences April 2024. We do not expect a shortage of soybeans in Zambia next 12 months. The next graph shows price history of Zambian soymeal, soybeans and crude soya oil import parity from Argentina. As indicated in a previous podcast, Zambia is a net importer of edible oil and therefore import parity is the benchmark. Both the soybean and soymeal price increased significantly since late June. Soybeans up 40% to $450 a ton, and indications bigger parcels could fetch up to $500 a ton. Soymeal price up by 45% to $480 a ton. Rather difficult to find fundamental reasons for the recent price spike. International prices are under pressure. See the graph indicating the India CNF soybean price history for the last 3 years. India is a frequent export destination for Zambia beans of late. The higher soybean price has stopped deep sea exports via Dar es Salaam to India, Pakistan and China. The higher soymeal price has stopped exports to South Africa. South Africa should be the main soymeal export destination given the record crop and crush expectations. One factor mentioned is import parity of South African origin soybeans to Zimbabwe, currently at $570 a ton, which discounts to an export parity Zambia destination Zimbabwe of around $500 a ton. Question is, will Zambia meet the Zimbabwe import need through soybean and soymeal exports? Not an easy question to answer, and potential further deep-sea soybean exports will play a part. Also, not impossible that Malawi and Mozambique soybeans can find a way to Zimbabwe if prices are attractive enough. Given current Zambia prices, could see them lose the export market share to Malawi and Mozambique. So the big question is where prices could be heading short, medium term. Given the factors mentioned above, it is a rather complex question. We feel prices could be close to the short-term top of the cycle. Should Zimbabwe need to import soybeans and soymeal from South Africa, Zambia prices could move sideways. However, if the Zimbabwe import need is met by Zambia and potentially Mozambique and Malawi, there could be short-term price downside. Last but not least, this week we heard, could not confirm, the Zambian Minister of Agriculture has suspended the issue of soybean export permits. The Crushers and Edible Oil Refiners Association of Zambia, short SEDORA, complained they cannot find soybeans and the little available is being exported. They indicated this could lead to high edible oil prices. This move by government could pressure soybean prices short term.
Thank you very much, Jacques, for sharing such valuable insights. For those seeking more detailed information and comprehensive reports on sub-Saharan African soft commodity markets, I encourage you to reach out to Jacques Pinaar. I'm Dr. Johnny van der Merwe, and thank you for watching.